Hello, everyone. Today, we're going to focus on a topic that is both familiar and cutting edge, the application of big data in the financial sector. Some of you might think big data sounds abstract, but in reality, it influences our financial lives every single day. For example, when you receive a fraud alert after swiping your credit card, or when your phone pushes personalized investment recommendations, big data is working behind the scenes. Today, we'll explore 4 key questions to understand what big data actually does in finance. First, how does big data help protect us from fraud? Second, how does it make financial risks more controllable? Third, how has big data transformed credit reporting systems? And fourth, how does it enable financial services to better understand users? Once we've answered these 4 questions, you'll have a clear grasp of the core logic behind the application of big data in finance. The first question: how does big data keep a watchful eye over financial transactions? In other words, how does it help with fraud prevention? Traditional anti-fraud systems are like security guards at the gate of a residential complex. They mainly rely on familiar faces and manual registration, and when something unfamiliar shows up, they may not react fast enough. For example, in the past, someone could apply for a credit card using a fake identity. As long as the documents look legitimate, they might slip through the cracks. With big data, however, it's like installing 360-degree surveillance cameras powered by intelligent analysis. So what exactly does big data keep an eye on? For instance, if you usually use mobile banking to transfer money around 8 p.m., but suddenly your account logs in at 3 a.m. from another country, using a computer, and attempts to transfer a large sum of money. These kinds of abnormal behaviors will immediately be detected. The system then calculates a risk score in real time. Once the score exceeds a certain threshold, an alert is automatically triggered. This could mean asking you to enter a verification code, or even having customer service call you directly to confirm the transaction. Data shows that after adopting big data-driven anti-fraud systems, many banks have reduced losses from telecom fraud by over 60%. Simply put, the core idea behind big data anti-fraud is as follows: by analyzing your past behavioral patterns, it identifies actions that don't fit in and shuts the door before scammers have a chance to succeed. The second question: how does big data predict financial risk? In other words, how does it support risk control? In the past, when banks issued loans, the process was like traditional Chinese medicine. Doctors relied on observation, listening, questioning, and post-taking. Banks would look at your income statements, check your collateral, ask about your employer, and then estimate your ability to repay. But this approach could easily miss the mark. For example, someone might have a high income but spend money recklessly, which means their actual repayment ability isn't as strong as it appears. Big data, however, is like giving the doctor a CT scanner. It reveals a much more comprehensive picture of your financial health. It collects information such as your salary flow, credit card repayment history, and even data like food delivery orders or ride-hailing frequency. For instance, if someone spends more than half of their monthly income on ride-hailing, it may indicate higher living pressure. Based on these data points, the system builds a risk profile for each individual. Paying rent and utility bills on time earns positive points, while frequent late repayments reduce the score. For example, a small grocery store owner wants a loan to stock inventory but doesn't have property to use as collateral. Big data analysis shows that his monthly cash flow is stable, he has never delayed payments to suppliers, and even his Make-One food delivery income records are consistent and regular. All of this provides strong evidence of his repayment ability, giving the bank the confidence to approve the loan. That's the power of big data. It helps reliable borrowers, who might have been excluded in the past, gain access to credit, while stopping borrowers who look impressive on the surface but carry high hidden risks. The third question: How much more comprehensive have credit reports become with big data? In the past, a credit report was like a student's transcript. It mainly recorded exam scores, loan and credit card histories. If you had never taken an exam, never applied for a credit card or taken out a loan, your report would be blank. This is what we call a credit invisible customer. With big data, however, credit reporting has become more like a comprehensive evaluation. So what kind of information gets included? For example, whether you pay your utility bills on time, whether you properly return shared bikes, or even whether you frequently abuse return policies on e-commerce platforms. There's a real-life case. A recent college graduate had never borrowed money before. When he applied for a credit card, he was initially rejected. But big data analysis showed that he paid his rent on time every month and had even made donations through online charity platforms. Based on these behavioral records, the bank approved his first credit card. This is the contribution of big data. Credit is no longer judged solely by whether you have borrowed and repaid money, but by the sense of responsibility reflected in everyday life, giving more people the opportunity to build and demonstrate their creditworthiness. The fourth question: how does big data make financial services truly understand you? In other words, how does it enable customer profiling and precision marketing? In the past, financial marketing was like handing out flyers in a shopping mall. Whether you needed them or not, they were pushed to you anyway. For example, someone who has just graduated and has limited savings might still receive promotions for high-end wealth management products, which are clearly a poor fit. With big data, marketing becomes more like a recommendation from a friend, often hitting exactly what you care about. So how does it work? If the system notices that you regularly transfer money to your parents and frequently search for pension insurance, it can infer that you may be paying attention to retirement-related financial products. If you travel frequently for work, it might recommend a credit card that includes flight travel accident insurance. Some banks have found that after adopting big data-driven precision marketing, customer acceptance rates increased by 3 times. Customers receive far fewer irrelevant promotional messages. One important point to clarify is that precision marketing is not about surveillance. It is based on the behavioral data you voluntarily generate. The ultimate goal is to make financial services more considerate, not to create unnecessary annoyance. To wrap up, the 4 applications of big data in finance are essentially addressing the same core goal: making financial services safer, fairer, and more considerate. Anti-fraud systems keep bad actors out, risk control safeguards the bottom line, credit reporting expands the boundaries of credit, and precision marketing ensures that the right services reach the right people. As technology continues to evolve, big data will bring even more changes. Yet the underlying logic remains the same: letting data speak, while keeping people in mind. I hope today's discussion has helped you understand why big data is not just about cold numbers, but a tool that adds warmth and humanity to financial services. That's all for today's class. In our next lesson, we'll talk about the challenges that come with these technologies.